Most traders overcomplicate trading, but the truth is you only need 3 core concepts to become profitable. The problem is most people learn them separately and never understand how they actually fit together. So in this video, I'm going to break down the 3 concepts that form a complete trading system and show you exactly how to combine them step by step to start trading with real structure and consistency.
The first concept is market structure, and this consists of uptrends and downtrends. An uptrend is a market that is printing higher highs and higher lows, simply meaning each high that forms is higher than the previous, and each low that forms is also higher than the previous. A downtrend is the opposite, where a market is forming each low lower than the previous one, such as this low being lower than this one, and each high evidently lower than the previous. Now obviously, we want to buy during uptrends and sell during downtrends. A consolidation is the third type of phase, and a consolidation is simply a sideways price range that provides no opportunity for buys or sells. It can pretty much be indicated by a market that is not forming any significant new highs or lows. So in this instance, you can see each high and low that's formed within this range is confined by the larger structure. Consolidation provides no direction, so there are no trades there. Through uptrends, we buy. Through downtrends, we sell. Now, during price movements like this, we get what we call impulses and corrections. An impulse is a pro-trend move. So in an uptrend, the impulsive moves are the strong up moves. An impulse is defined when a new high has formed. So here we have an impulse, then we have a higher low, then we have an impulse, and because it broke the structure and formed a new higher high at the end of this movement, that is why this has become an impulse. Now each of these movements in this uptrend are impulses because they each formed a new higher high. The same goes for impulses in the downtrend. When the structure breaks to a new lower low, such as when we broke the structure at this point here and formed this new lower low, that is the impulsive movement. That's the first impulse in the bearish trend. Every following movement that breaks structure from there is also an impulse. So when we come down and break through this lower low and make a new lower low, that's an impulsive move. Now the other type of movement is the correction or a corrective move. And the correction is simply a pullback. So see here, we have this pullback movement which forms the higher low. That is the correction. And every movement following is also a correction when it pulls back to form a new higher low. Now the reason that we can define these as corrections and not impulses is because they didn't break any previous structure. So let's highlight this area just here. We can see that we pulled back from this high and came down to this level. Now, because we didn't break through this higher low, the market trend stays intact. It's an uptrend because we're still forming higher highs and higher lows. So this becomes a corrective move and not an impulsive move. If the market had driven all the way down like this and broken through the previous higher low, then this would no longer be a correction. This would actually be a bearish impulse, which is generally then what leads into a new downtrend. So when we are trading, we're initially looking to find out what way the market's going. So let's say the market is in a downtrend because we've seen lower lows and lower highs forming. Our goal is to then wait for a lower high to form these corrective movements. And on this pullback, on this corrective move, we are then looking to sell the high. So we want to use these pullback opportunities to sell from. And then our trade would carry on down into new lows. And then we would use other elements to identify where our targets are going to be. And we will discuss those shortly.
Now that you understand the concept of market structure, let's look at a real chart example and map it out.
So we have initially a low in this market. We then have a push up and we break structure. So because we pushed up and we broke structure, we can classify this area as our higher high. The market then pulls back and forms a higher low. Then we have a push up. We form a higher high. Now the reason we are classifying this higher high and we're not so worried about any of the structure before this is because this is where we started to break the trend. So we have the previous higher high at the top of that wick. The market's now pushed up, broken that structure. So this becomes our new higher high. We then had a pullback down from that point to form a higher low once again, and a push to the upside to create a higher high. So if we consider the trending structure of this market, this phase is in an uptrend. Let's mark the uptrend we have from this low to here is an uptrend. Now from this point onwards, we had a little bit of consolidation, which would be pretty much this area just here. The market didn't really make any ground in that area or even down to this point either, because at this point we had maintained price above this higher low. So the higher low is there, meaning anything that happens below this high and above this low is nothing more than a consolidation. But as you see, after this consolidation phase, at around this point here, we actually did get a break of structure where this higher low was broken. So this now puts us into an impulsive downtrend, meaning this would be the first impulse in this bearish trend. Then we have a corrective movement back up just here. We have the formation of a lower high. The market comes down, makes a lower low. We pull back up, we form a lower high. We pull down, we make a lower low. So that would be the two phases of market structure. Also the three phases, because we consider the consolidation within. We have the uptrend, we have the consolidation, and then we have the start of the new downtrend. Here's an interesting point. After we formed this low in the market, we had this pullback up. And if we consider the structure that we just marked, we have actually broken a couple of the smaller structural points. But after seeing this happen, the market then sank back to the downside. Now this is sometimes going to happen. The market may trick you into thinking it's broken structure, and then it will just continue moving in the larger bearish direction. This is just something that cannot be avoided in a game of probabilities, but I wanted to make you aware of that so you could see that nothing is perfect. So in hindsight, now that we've had this kind of inducement, this tricky movement where the market's pulled higher, we could map the structure as here's the high, lower low, lower high, lower low, lower high. We could then consider this lower low and lower high. Then we have this lower low. We then have this pullback, which tricks us into thinking the trend has shifted. But then we have a sell-off to the downside. So let's extend the structure mapping a little bit further then. We see we come down through this low. We form a new lower low down here. Then the structure starts to shift once again. So our lower low is there. We have a lower high coming in at this level. And then after we form this lower high, the market actually breaks into an uptrend. So this push up here is the start of a new uptrending sequence because it's a bullish impulse. From this low up to this high, we actually now pushed through the previous high, putting us back into an uptrend. And as you can see, following on from that point, we then moved into a phase of bullish price action. And this continued on for a while.
So that's concept number one, which is at the core of the market structure. Now we're going to move on to another concept, which is the best one for finding our entries and targets or positions, and that is supply and demand.
So here's an example of what a supply and demand zone looks like in a market. A supply or demand zone is an area of consolidation before a large up or down move. Demand is for buys. So this is a demand zone right here. In an uptrending market, a zone before a large upward move would be a demand zone. A supply zone is the same, but it's in a selling market. So if the market is in a downtrend, we want to identify, once again, consolidation areas before large down moves. And this is where our supply zone is going to be. Now, to explain the theory behind supply and demand, we are basically considering the auction theory of the market. This supply and demand zone is taking place between the levels of 1.03617 and 1.02884. And what this means is that the price range between those two levels that we've just discussed was seen as a discount price to buy an asset. Now, the reason that we see this, and the reason that the market is telling us this, is because this is where the market took off from previously. And because markets move based on buying and selling, that shows that this area here was where a lot of the buying took place, because that's actually what causes the market to go up like this. The same goes for selling movement, where this is actually seen as a premium price to sell from. So if the market gets too high, traders will start selling and taking profits, or short selling the market, expecting it to go down. And the fact that we've seen the market consolidate and then sell previously tells us that this is one of those premium price areas. Now, from a demand perspective in an uptrend, then think about this. If a considerable number of important market participants have seen this price range as a discounted price to buy from, if the market gets back here, would it be unreasonable that traders would want to buy again because it's a discounted price? It's a good price to pay for the asset. That is how supply and demand works. Now we can expect that if the market does make its way back down, the price will be cheap enough for traders to buy once again, which will lead us into a new push in the uptrend. And the same is true for selling, but we're seeing that premium price to sell from. You don't want to sell your assets if they're trading down here, or you don't want to short sell the market down here because the price is too low. It's better to sell high and buy low, as you've probably heard people say in the investing and trading space many times. So we are looking to sell from premium areas and buy from discount areas when we're considering supply and demand. Now, when it comes to plotting supply and demand zones, we are going to be using individual candlesticks. A demand zone for me is the last candle before the impulsive move to the upside, and a supply zone would be the last candle before an impulsive move to the downside. Now, some people follow a rule that they should use the last down candle before the up move and the last up move before the down candle. But for me, honestly, I don't care what color the candle is. I don't care if it's a bearish candle or a bullish candle. I like the last candle before the impulse. And the reason for this is that the last candle before the market took off is showing the area of which major buying was accumulated, because of course the buying immediately followed. So the last candle before the impulse, which is generally going to be a doji candle like this with little to no movement and reasonable wicks on either side, that is where I want to be using for my supply and demand zones. Heading into that new phase of upward structure that we just started to look at, we have structural shifts from bearish to bullish. So we have this lower low, lower high, lower low, and then we have this break into a higher high, and then we start the uptrend. Now, once the market breaks into this higher high, just here, this is where we can start identifying where to buy from. And this is where we're going to use supply and demand. Now, obviously, because we're in an uptrending market here, our focus is going to be on demand zones. We only want to buy demand in uptrends and sell supply in downtrends. Now, as I've said, the last candle before the impulse is going to be where I want to buy from. So we can see here, we have this candle, this doji candle, as we've said before, an indecision candle with wicks either side. And we could use this to plot our supply and demand zones. This is going to be a demand zone. Now, because this was seen as a discounted price to buy from, and because this is where we started to see a new movement into a new trend, this demand would be the area we would look to buy from. And when the market returns to this level, we would be happy to buy from here. So our buy position would be executed at this area just here, specifically pretty much along this level. Now, when we're using supply and demand for buys, we would generally be entering on the top of the zone, and our stop loss would go below the zone. So the stop loss would be under the low to make sure that we have a safe entry and a safe stop loss, meaning a hypothetical position buying from this demand would be a buy there with a stop there, and then our targets would look to extend through into new highs because we know the market is now in an uptrend. As you can see, pushing this forward, that is exactly what happens.
So now we've paired structure with supply and demand. There's one more thing we need to consider, and that is a theory of market efficiency and inefficiency.
This theory suggests the market trades in two different scenarios: efficient scenarios and inefficient scenarios. An efficient scenario is basically a market that is continually moving either up or down, but retesting every demand or supply zone. So you can see that in this phase, we have pushes away, we form demand zones, and then we come back and retest those demand zones. So there was no open gaps left in price. Every time we form a demand, we pull back and retest that demand. Now, an inefficient market is actually where we start to form open price ranges like this here. So you can see from this movement, we formed a demand zone. Then we had that nice impulse away from the demand zone. So we know we're in an uptrend, but the market hasn't yet come back to retest that demand. So this actually leaves us with what we call an imbalance or an inefficient price range. So this open price move here, pretty much below this low, is going to be the imbalance or inefficiency. And when we see inefficiencies like this, it's very much likely that the market will fill this at some point in the future before continuing with the significant movement of the trend. So if we were to see the market pull back as I've drawn on, even though we would actually be seeing a break in structure at this point, we wouldn't immediately consider this shifting into a downtrend because we know there's still this inefficiency that is likely to be filled. Now, there generally won't be many transactions taking place between these inefficiencies, between these open price ranges. So when we see an inefficiency open like this, we are still very much interested in seeing the market pull back through that because there's not many orders taking place within, and the orders will be waiting down here. When orders are activated, that opens doors to new reversals and new movements in the market. Let's translate this to the charts. We had the structural shifts to the upside. We marked out our demand zone. And now, with that new tip in mind, you can see we actually have one of those open price ranges just here. So although the market, if we considered it from a lower time frame perspective, has formed higher high, higher low, higher high, higher low, higher high, higher low, higher high, and then we actually broke some structure to the downside just here, this wouldn't become a full-blown downtrend. We would only use this to target any inefficient price ranges, which would mean we would only use this to at maximum target sells into this demand, because once this demand is filled, it's likely that we react from this inefficiency. We fill the inefficiency, we hit demand, and then we get a new bounce into a new uptrend price action, as we've seen take place in this market. So with that efficiency and inefficiency in mind, these can be really great places to target for shorter term small trades. So we could look at short positions, sell positions through this range, and second of all, actually use for our entries. Now on that note, we would never want to buy from a demand zone that wasn't efficient. So see here, for example, we have a demand. The market has retested this demand already. Buying at this point would be okay on the first retest of demand. But now that this demand has been retested, it should absolutely not be used for future buys. So this area would absolutely not be valid for any buys because there's no inefficiency left in this zone, whereas the zone below still has that inefficiency. So this one would be the good one for our position to take place. So all things considered then, this position has had a break of structure to the downside and then a break of structure to the upside, shifting the market into bullish price action or an uptrend. In doing so, we found a demand zone kicked off the movement, which is this demand zone down here. And just above the demand zone is an open price range, also known as inefficiency or an imbalance, which adds to the fact that this is likely to be filled and makes this area a high probability place to buy from. Now, because we know the market is now in an uptrend, we have pretty clear targets of either targeting previous highs, such as this high here, or extending the trade even further to tackle some of the open supply areas up here. We could actually consider this area of supply for a potential target now that the trend is moving up. Our buy position then, for a nice, simple setup, would be buy limit on the demand zone, stop loss beneath the demand zone, and then target into either previous highs in the trend or open areas of imbalanced supply or demand. In this instance, because we are now in an uptrend, our target would be this open, imbalanced supply zone. And as you can see, the market trades through and fills into this region.
So for full transparency, the one I just showed you was not a trade that I took, but the one I'm about to show you is, and it follows the exact same piece of price action and uses the exact same concepts, and it's a safer, better trade.
Now, in order for me to show you this next trade example, I first need you to understand the concepts of swing structure and substructure. It's not too complicated, don't worry. Basically, swing structure is going to be the larger movements. So when we're in an uptrend, the swing structure movements are those impulsive movements that we see. If we see a market like this, we know it is bullish from a swing structure perspective, but the concept suggests that within the swing structure uptrend, in the corrective movements, there's going to be smaller trends. So let's say we are looking at the 4-hour time frame for this bullish upward trend. Within the 1-hour and 30-minute time frames, we may see bearish price action and bearish trends happening within the corrective movements. So we will actually see smaller trends inside of the larger trend when we start to look at different time frames. And what we can actually do as traders is use this lower time frame to validate trades even more. If we think we found the higher low in an uptrending market, we can actually use that substructure and the lower time frame trends within the higher time frame trends to identify shifts of their own. So see here, in this downtrending market, we have this lower high, we have this lower low, and then the market breaks up to form this higher high. Well, this would be the validation of a bullish movement on the lower time frame. We have validation of bullish movement on the higher time frame. So as soon as we get this agreement that we're seeing in this area here, that confirms setups and gives us the highest probability way to get into trades. Now, I don't want to confuse you with this too much. So let's jump back over to the charts and we'll show you how that works in reality. So this is the trade we've just been looking at. We had the break of structure just here. We have this higher high. The market came down. We retested here and formed a higher low. And then the market pushed up. And this is where we're going to be considering that sub and swing structure. Now, from this perspective, just real quick, we can see that with this shift from bearish to bullish, we now have a swing structure bullish market. The higher time frame structure that we're viewing there is definitely bullish, so we want to buy. Now, if we consider then the range from this high down to this low, this is where the substructure concept comes in. We can actually see that within this movement, we've got smaller trends. So we have this kind of higher high, higher low, higher high, then we break into a lower low, a lower high, a lower low, a lower high, and then we have this area, lower low, lower high, then we have the low. So within the corrective movement of this bullish trend on the higher time frame, we notice a visible bearish trend on a slightly lower time frame or a more refined view. We have this point here, which is a potential lower high. And then we have this point here, which is more clear as a definite lower high. So what we would be looking for would be a break in the trend to then confirm that this lower time frame agrees with the higher time frame, which is now bullish. So we've seen bullish higher time frame. We want to see this now agree with a bullish lower time frame. And as you can see here,
when the market pushes above these structural points, that validates that the low time frame now agrees with the high time frame, which means we can use the other concepts we've covered to find a very safe trade. So now that the low time frame agrees from a structural perspective, we want to, number one, use imbalance to identify open price ranges. Number two, use last candle before the impulse to identify areas of supply and demand. And then we would be ready to start making our trades. So we have an efficient range now that the market has filled that previous area of demand that we just looked at. We've had a lower time frame shift and structure forming higher highs at this point here. We've then had a pullback to fill this imbalance or this market inefficiency, and we've had a retest of this demand zone. So if we were to place our buy limit on this demand zone with the stop loss just below the low, and once again follow that same thesis of targeting previous highs in the trend, such as this open imbalanced supply zone, we would be able to get a confirmed entry from there. And the reason we call this a confirmed entry is because we haven't just worked with this higher time frame structure to find a position, but we've actually now seen the exact same thing taking place on a lower time frame. So we basically have this exact same format happening on a smaller scale, which means the high time frame agrees with the low time frame, which gives us the highest probability entry for our positions. Risk to reward is how much you risk versus how much you stand to gain. So in this position, we risk 1% for the potential to make 6%, as you can see just there. This means that we only would really have to be right 1 out of every 5 times in order to be a profitable trader. Now obviously, with a system that's going to achieve around 50% win rate, you will win more trades than that. But it gives you extra peace of mind that you don't have to win every trade to remain profitable. And that's it. That's how you can use 3 simple price action concepts to build a successful trading system. Now, if you want help to be a profitable trader, click the link in the description below for your free strategy call. I help busy professionals and entrepreneurs to be a profitable trader in less than 4 hours a week using my proven market edge system.